Decentralized lending and borrowing. One of the most common services offered by the financial industry is the lending and borrowing of funds, which was made possible by the concept of credit and collateralization. It can be argued that the invention of commercial-scale lending and borrowing was what brought about the Renaissance age, as the possibility for the less wealthy to acquire startup funds led to a flurry of economic activity. The economy began to grow at an unprecedented pace. Entrepreneurs can borrow the upfront capital needed to establish a business by collateralizing the business, while families can get a mortgage for a house that would otherwise be too costly to buy in cash, whilst using the house as collateral. On the other hand, the wealth accumulated can be lent off as capital to lenders. This system reduces the risk of borrowers absconding with the borrowed funds. However, this system requires some form of trust and an intermediary. The role of an intermediary is taken up by banks, and trust is maintained via a convoluted system of credit, whereby the borrower must exhibit the ability to repay the loan in order to be qualified to borrow, among a laundry list of other qualifications and requirements by the banks. This has led to various challenges and shortfalls of the current lending and borrowing system, such as restrictive funding criteria, geographical or legal restriction to access banks, high barriers to loan acceptance, and the exclusivity of only the wealthy to enjoy the benefits of low-risk high-returns lending. In the DeFi landscape, such barriers do not exist, as banks are no longer necessary. With enough collateral, anyone can have access to capital to do whatever they want. Capital lending is also something that is no longer enjoyed only by the wealthy. Everyone can contribute to a decentralized liquidity pool of which borrowers can take from and pay back at an algorithmically determined interest rate. In contrast to applying for a loan from the bank, where there are stringent know your customer and anti-money laundering policies, one only needs to provide collateral to take a loan in DeFi. We will explore just how such bankless lending and borrowing mechanism is possible with Compound Finance, a DeFi lending and borrowing protocol. Compound Finance is an Ethereum-based open-source money market protocol where anyone can supply or borrow cryptocurrencies frictionlessly. As of February 2020, 7 different tokens, namely Basic Attention Token, DAI, Ether, Augur, USD Coin, Wrapped Bitcoin, and 0x, can be supplied or used as collateral on the Compound platform. Compound operates as a liquidity pool that is built on the Ethereum blockchain. Suppliers supply assets to the pool and earn interest, while borrowers take a loan from the pool and pay interest on their debt. In essence, Compound bridges the gaps between lenders who wish to accrue interest from idle funds and borrowers who wish to borrow funds for productive or investment use. In Compound, interest rates are denoted in annual percentage yield and differ between assets. Compound derives the interest rates for different assets through algorithms that account for the supply and demand of the asset. Essentially, Compound lowers the friction for lending, borrowing by allowing borrowers to interact directly with the protocol for interest rates without needing to negotiate loan terms, which are maturity, interest rate, counterparty, collaterals, thereby creating a more efficient money market. How much interest will you receive, or pay? The annual percentage yield differs between assets, as it is algorithmically set based on the supply and demand of the asset. Generally, the higher the borrowing demand, the higher the interest rate, and vice versa. Using the DAI stablecoin as an example, a lender would earn 7.58% as of February 2020 in a year, while a borrower would be paying 8.00% interest after a year. Do you need to register for an account to start using the Compound? No, you do not need to register for an account, and that's the beauty of decentralized finance applications. Unlike traditional financial applications where users are required to go through lengthy processes to get started, Compound users do not need to register for anything. Anyone with a supported cryptocurrency wallet such as Argent and MetaMask can start using Compound immediately. Start earning interest on Compound. To earn interest, you will have to supply assets to the protocol. As of February 2020, Compound accepts 7 types of tokens. Once you have deposited your asset into Compound, you will immediately begin to earn interest on the assets you have put in. Interest accrued on the amount that you have supplied and is calculated after each Ethereum block with an average of 13 seconds. Upon deposit, you will receive corresponding amounts of cTokens. If you supply DAI, you will receive cDAI. If you supply Ether, you will receive cETH, and so on. Interest is not immediately distributed to you, but rather accrues on the cTokens which you now hold and are redeemable for the underlying asset and interest it represents. What are cTokens? cTokens represent your balance in the protocol and accrue interest over time. In Compound, interest earned is not distributed immediately but is instead accrued in cTokens. Let's go through this with an example. Assume that you have supplied 1,000 DAI on the 1st of January 2019 and APY has been constant at 10.00% throughout 2019. On the 1st of January 2019, after you have deposited 1,000 DAI, you will be given 1,000 cDAI. In this case, the exchange rate between DAI and cDAI is 1:1. On the 1st of January 2020, after 1 year, your 1,000 cDAI will now increase in value by 10%. The new exchange rate between DAI and cDAI is 1:1.1. Your 1,000 cDAI is now redeemable for 1,100 DAI. To account for the interest accrued, cTokens become convertible into an increasing amount of the underlying asset it represents over time. cTokens are also ERC-20 tokens, meaning you can easily transfer the ownership of supplied assets if someone wants to take over your position as a supplier. Start borrowing on Compound. Before borrowing, you have to supply assets into the system as collateral for your loan. Each asset has a different collateral factor. The more assets you supply, the greater is your borrowing power. Borrowed assets are sent directly to your Ethereum wallet and from there, you can use them as you would any crypto asset. Do note that borrowing incurs a small fee of 0.025% to avoid spams and misuse of the Compound protocol. The price movement of the collateral asset. If you're thinking about putting in collateral to take a loan, you may be wondering, what happens if the value of the collateral changes? Collateral value moves up. If the value of the asset you used as collateral goes up, your collateral ratio also goes up, which is fine, nothing will happen and you can draw a bigger loan if you'd like to. Collateral value moves down. If the collateral goes down such that your collateral ratio is now below the required collateral ratio, your collateral will be partially sold off along with a 5% liquidation fee. The process of selling off your collateral so that you achieve the minimum collateral ratio is known as liquidation. Liquidation. Liquidation occurs when the value of the collateral provided is less than the borrowed funds. This is to ensure that there is always excess liquidity for withdrawal and borrowing of funds, meanwhile protect lenders against default risk. The current liquidation fee is 5%. What is a dashboard? A dashboard is a simple platform that aggregates all your DeFi activities in one place. It is a useful tool to visualize and track where your assets are across the different DeFi protocols. The dashboard is able to segregate your assets into different categories such as deposit, debt, and investments. Typically when you access your dashboard, you will need to enter your Ethereum address. Alternatively, you could enter your Ethereum name service domain. ENS domain is a human-readable Ethereum address that you can purchase for a period of time. There are several dashboards in the market with the capacity to track your assets like Frontier, InstaDApp, MyDeFi, and Zerion. DeFi represents the future of finance. At the start of 2020, the total value locked in DeFi dApps hit a significant milestone of $1 billion. In other words, that's the total amount of programmable money currently stored in smart contracts that serve as the building blocks of an entirely new decentralized financial system on the internet. While $1 billion locked into DeFi may seem like a small number compared to traditional financial markets, the growth has been staggering. Quick summary of the journey. 2018, total value locked increased 5 times from $50 million to $275 million. 2019, total value locked increased 2.4 times to $667 million. 2020, total value locked reached $1 billion as in February 2020. What are the things DeFi allows us to achieve? Transparency. A transparent, auditable financial ecosystem. Accessibility. Free access to DeFi applications without fear of discrimination on race, gender, beliefs, nationality, or geographical status. Efficiency. Programmable money makes it possible to remove the centralized middlemen to create a more affordable and efficient financial market. Convenience. Money can now be sent anywhere, anytime, and to anyone who has access to a cryptocurrency wallet for a small fee and with little waiting time. All of the above have made it possible for users to do some of the following: provide liquidity to earn yields on unproductive assets with no maturation, lock-in period, take loans with collateral without paperwork and repay them anytime, and execute automated trading strategies easily. What about DeFi user experience? Wallet. Argent is creating a radically better user-focused crypto wallet experience, with free transactions on Ethereum without needing ETH, native integration with Compound, as well as not needing seed keys. Participation of products. DeFi Zap abstracts away many of the complexities and steps involved with DeFi products and allows users to access multiple financial products in one transaction, saving time and effort. User-friendly development. Gelato Finance recently launched their If This, Then That for crypto. It basically allows users to set actions that will be done once certain conditions are met, such as buy ETH when it is $200, or send some money to Sharon when it's her birthday. Insurance. The financial market effectively facilitates the transfer of risk. One man's hedge against his position is another man's profit. Insurance is now available, as we've covered earlier, via Nexus Mutual or Open. If you are willing to accept a lower yield on the money you've placed on lending protocols such as Compound in exchange for peace of mind, it can now be done. Aggregation of liquidity. There are many different decentralized exchanges in the market with varying liquidity, and it is a headache for users to choose which one is the best for their trade. This is slowly becoming a thing of the past with liquidity aggregators such as 1inch Exchange, Paraswap, and DEX.AG that helps to automatically split orders across DEXs to ensure the best possible prices. Yield optimization. Remember switching around different banks for the best rates for fixed deposits? You don't have to do that in DeFi yield bouncers like Idle Finance, DeFi Saver, and iEarn automatically allocate your crypto assets to places with the best yield opportunities on the Ethereum blockchain. Subscribe the channel and thank you for watching.